RSI stands for Relative Strength Index. It is a momentum oscillator that measures the velocity and magnitude of price movements. On a scale from 0 to 100, when the index is at 70 and above, it's traditionally considered overbought, while 30 and below is looked upon as oversold. Let's look at how traders might use this indicator to identify potential trading signals. Some traders define oversold as an RSI value below 30. When RSI crosses back above 30, it generates what some technical traders generally see as a potential bullish entry signal. Exit signals work the same way, except traders use overbought values. Technical traders view an RSI value above 70 as overbought. When RSI crosses back below 70, technical traders typically see it as a potential exit signal. However, this doesn't mean using RSI is foolproof.